I will start with Monsieur Francois Kayat, who has a long and eminent track record in banking, from Credit Suisse First Boston to Crédit Agricole, and presently is managing director at Lazare Frères in Paris. Monsieur Kayat.
Thank you, Dr. Gaspar. What I'm going to try to do today is to give you some perspective more from a financial market angle as to whether oil and gas in Lebanon can be financed or not. And I'm just going to be very factual and just walk you through what's happening in the market at the moment, what is doable, what is not doable, how people do it, and then we'll have a few words about Lebanon, and I think the rest of the conference is going to expand on that. I'm very humbled by the quality of the presentations that we've heard this morning. I'm only a banker. It seems like I'm the only banker, so I'll try to limit my comments on only to that. There are a number of, if I can work this, yes. A number of things have been said about what's going to happen to the oil prices, and I do not pretend to have any particular view. What I can do, again, is just highlight the way things are being perceived in the market. This is a graph coming from the recent release in May by the International Energy Agency, and what it shows is that there is a sort of rebalancing between the supply and demand curve. That probably allows for the small rebound that we've seen in the oil prices at the moment. Having said that, even though it looks like we've entered in a sweet spot and the prices have recovered slightly, I think that this could be reasonably short-lived. If we go a little bit further in the analysis and we look at what the markets are telling us as opposed to the economists and the provisions that one can build, what I've tried to highlight here is straight out of Bloomberg. What are the oil prices? That's the graph that you see on the left, and the two extrapolation lines, which are basically the future prices. And the future prices as they were in the market recorded on the 9th of May and the 18th of April. So you can see that there is a slight improvement in the overall perception by the market of the prices of oil in the future. Having said that, I think we should also say that according to the IMF, there's still a significant probability that the oil price falls below $25 a barrel. And I think I don't know how they do that, but I mean, they've calculated that to be a 6% probability. There's also a general market consensus that basically says the price of oil is not going to go beyond $50 in the next 12 months. So a reasonably slow recovery, and I don't think that there is much to expect on that front. Now, the consequence of that, obviously, and you've heard about it, is that it has had an impact on the capacity of the operators in the sector to invest in the development of oil and gas products. So looking at the graph on the left here, this is an extract from a study done by Wood Mackenzie. And what I try to show is for various categories of or themes of project, deep water, shallow water, and onshore. The red dot that you see here is the average break-even cost, break-even point for the for exploiting oil and gas in oil in these categories. And the dotted line that's horizontal shows the current oil price. The result of that, obviously, is that there is less profitability. Less profitability leads to less investments, and that's what you see on the red graph, on the graph on the right. The problem there is a little bit compounded by the reaction of operators in the financial markets. The reality is that when you look at it, companies have got more capex than they have got dividend, for example. There's a huge debate at the moment as to the extent to which oil companies should cut their dividend and should keep their cash for investment in their own thing. There's also financial logic. Maybe that could be a little bit more short-termist, but that logic is still there. That's preventing companies to slash their dividend as much as maybe they would have hoped to do. So as a result of that, what we've seen is a decline of capital spending of nearly 20% in 2015 compared to 2014 for companies in general. If we look at E&P, I think that decline is 30%, 15 over 14 for the investment. So a pretty grim story that the market is telling us here. Also, the sequel to all of these things is the sort of consolidation that we're seeing in maybe not directly in the oil sector, but also in the oil services sector. And the logic behind that is the ability for companies to slash costs. So that, again, is going to have an impact on what is happening in the sector in general. So where do we go from there once we've said that? Our experience is that it has led the operators at the moment to change a little bit the way they think about their investments. And if I can summarize that in three major themes, is that for the moment, the key thing for a company to engage into capital expenditure is to have some predictability. You need to make sure that the project you're going to go for is as clear-cut as it can be. Uncertainty is not going to help in an environment where you have to be very cautious with the way you spend your money. And when you're going to make choices and you've got a management of scarcity to do, you're going to try to choose things that give you the most clarity. The second point is operational costs. Many of the projects that are underway at the moment have been commissioned at the time when oil prices were significantly higher than they are now. So everybody's struggling to make sure that these things are going to be profitable. And this is going to be a constant theme in any new proposition that you're going to put to an oil company. If you want them to do and to spend money, you've got to tell them that, it's going to be done on the basis of predictability of CapEx, on the basis of low operational costs. And the last point is basically rapid CapEx conversion. Without going too much into financial jargon, the idea is you want to get a payback as quickly as you can, because you cannot afford, if the environment is going to be as bad as some people predict that it's going to be, you want to have a quick return so that you can keep on investing and move on to the next thing. So overall, capital discipline, a lot of capital discipline across the board. People are going to be very cautious about what they do, and I think that applies directly to a proposition that Lebanon can put to the international oil companies when it comes to developing the business here, and that is based on improved and predictable return on investment. And that's going to be the key word if we want to attract people to come here and help us. We'll talk about the consequences for Lebanon a little bit later, but let me now try to move on a little bit to, and I'm going to try to be as quick as I can here, but I just wanted to highlight the fact that, despite this context, there are still a number of sources of financing that are available. We can very quickly browse through the various categories, and then I'll highlight what would be important in the context of Lebanon and the fundamental choices that we'll have to make. But we can still tap the international bond markets for lots of reasons, macroeconomic reasons. We can go over the details of that. I don't think that this would be the forum, but there's still an enormous amount of liquidity in the markets, and that can be tapped. The difficulty is obviously because of what's happening in the sector. Operators and bond investors are getting increasingly cautious, and I think the key working word for them in order to invest in in an oil and gas project is going to be a credible completion story that we can put to them. And if you can't put that to them, I think we can forget about the bond market and then we move to something else. The advantage of the bond market, obviously, is that it can be, a less cumbersome and cheaper market for finance than bank debt, which is the next category. Bank debt, the benefit is that, we can rely on the experience and the understanding of the metrics by highly specialized team. They know exactly what they're doing. They understand what you're telling them, and they can do that. The big constraint at the moment is that some of these large banks have been badly hit by the crisis, in particular in the US. There are some balance sheet constraints because of diversification of risk, and they need to reduce their exposure to the oil and gas sector. So there would be constraints. But again, there are still some banks that are out there that are open for business and that are prepared to look at projects, provided they're projects that make sense for them. Export credit agencies and development finance institutions, there is a certain amount of public money that is available. It is sometimes a condition and a necessity to tap these pockets in order to be able to finance projects, depending on the regions in the world. Pluses and minuses. Plus is that it's usually cheap finance. Minus is that it commands an enormous amount of due diligence, and it's a very cumbersome project to put in place. So again, this is part of the picture, but complicated to put in place. Private debt has been an increasingly attractive category in financing recently. I think this is to a large degree dictated by the fact that we live in an environment of very low interest rates. All these insurance companies that are flush with liquidity need absolutely to find some yield to service their insurers, so they need to redirect that. One of the areas that they're focused on is infrastructure investing. Having said that, the quality of the project needs to be more of an infrastructure type category rather than a exploration and production, which by definition is riskier. And reserve-based lending, that comes a little bit later on in the process, before a field gets into production, but once the reserves have been proven, and this could prove a sort of reasonably efficient way of finding finance. So once I've done a little bit this categorization of the various sources of financing, I think the first question that we have to ask ourselves is, if we summarize that, what does it boil down to? What it boils down to is two broad categories. You can you can call it whichever way you want to call it. You can call it corporate finance, you can call it project finance, you can call it on or off balance sheet financing. The principal difference between the two categories is one is easier and faster. That's if you take your financing directly on your balance sheet, provided you have assets to guarantee that, and provided you have the credit rating that allows you to do that. The other one insulates the project from the rest of the environment. That could be an issue, for example, in a period where there is political instability. But at the same time, it is significantly more cumbersome and complicated to put in place. So to illustrate a little bit that, I'll just, and very briefly, touch on two examples of things my firm has been involved in. Totally different categories and circumstances. The first one on the left is the financing of a project aiming at exporting gas from Azerbaijan through to Turkey. That financing was decided to be done on balance sheet by the state of Azerbaijan. So basically what they did is that they managed their communication, and eventually the state ended up issuing, and I think we did that for them in March, a $1 billion bond, 10-year money that they raised in the market in March. And on the basis of that, were able to move on with their project, and this is now ongoing. At the other end of the spectrum, something we did a few years ago for Papua New Guinea, never know how to say that in English. Here the story is completely different. They have a project that was led by Exxon that involved a number of other companies, Nippon Oil, Oil Search, etc., and the state to the extent of 22.5%. So they set up a company. That company needed to raise some money. The state needed to contribute its stake into the company. And the state has a rating of B+, which is not too dissimilar to what we have, for example, in Lebanon. So that did not allow for a big financing in the market. And as a result of that, and because of the inability of the state to do its take directly, what we decided to do is to help them structure that as a project finance. So it took longer, it was more complicated to put in place, did all the study, got to the bankability of the project, and eventually managed to raise the money to do that. So these are the sort of choices that at some stage, project by project, we will need to think about to know how we're going to do that in Lebanon. So moving on to Lebanon, there are very little things that I can say that to add to what has been said and to what will be said a little bit later on, but it is obvious that the discovery of the oil field has created a large amount of hope, both to strengthen the energy security of the country and to boost the economy of the country. Having said that, a number of things have been put in place. The framework was put in place. In 2013, there was a pre-qualifying round that was launched that attracted a massive amount of interest by international companies. And then we all know what happened at the end of 2013, and everything was blocked. So where do we go from there? What we tried to show here are the key questions that we need to think about to keep this the momentum in this project. Readapting the exploration and production agreement. I think one way or another, the authorities will need to factor in what I said earlier about what are the sort of projects that will attract interest from international companies or not. And that is, and I think more will be said later on about that, that is a rebalancing of the government share versus the producer shares, and that is a fine balance that needs to be found to make the projects attractive. We need to think a little bit more about how we're going to do that. Are we going to find interest? It's hard to say, but the answer is probably yes, because we can see that money is still being invested in our neighboring countries as we speak. So there's no reason why there would be a lack of attractivity in what we're doing here. The second thing that we need to think about is that the investment period, the development period, is fairly long. What I've represented here on the chart is an average of 6 years to get there, because I think that's what conventional wisdom says, that it should be 6 years. Discussing that yesterday evening with Dr. Marcel, she just told me that her research shows that at the end of the day it is not 6 years. Practically it's more 10 to 15 years. So let's factor that in. Before we see oil coming out of that sea, it's going to take us, say, 10 years. So the longer we delay that decision, obviously, the longer it takes to get the benefit of that. And finally, maybe I'm not sure how I'm doing on time, but just to finish off on that, I think a long time ago, Burke said that all that was necessary for the triumph of evil was for good people to do nothing. And the only thing I want to say here is to thank the good people who put together this seminar for what they're doing. So thank you.